With us now is Regions Wealth Management Chief Investment Officer Alan McKnight. Welcome. Nice to see you.
Thanks for having me back.
So what are you telling your customers or your clients when they call and say, should I be adding more exposure here? This rally is running strong.
Needless to say, we get that question a lot, and we always reference back to Emerson said that a man is what he thinks about all day, and the first thing we think about is earnings. Earnings have been really good. In fact, they're actually better than what we would have expected at the beginning of this year. Then you go to the economy, strong, stable, maybe not everything we would have hoped for, but certainly not going over the cliff like some would have. And then on the FOMC front, one of the best times to invest in the market is when you're in the pause, not after a cut. It's a little counterintuitive, but if you look at the data, the best returns are typically during that pause period, and that's exactly where we are.
And would you tell them stick with the winners, the mega cap tech stocks?
We still like the mega cap tech stocks, and it's exactly what Mike was talking about. Earnings are there. The growth is there. We want to skew away from some of those sectors where they're not really able to deliver from an earnings front. We're going to get some more information this week from some of the retailers. What we've seen thus far is it's very much a tale of two cities. You have the low-income consumer struggling. You have the high-income consumer doing well. So we want to skew away from some of those and stick with those names where they're still able to deliver growth.
Yeah, your point on that is good. It kind of ties with year-on-year revenue growth, which is getting a little harder to come by. Weakest breadth in the S&P in about 4 years. Is that good because of what it might mean for price competition and inflation in the consumer? Or is it time to worry about corporate's ability to make better EPS with less revenue?
It's one of the things that we're struggling with right now, and really the question mark around, okay, are they going to be able to deliver from a revenue perspective? We've seen some price cuts of late, but with inflation continuing to run higher and hotter than the Fed would have liked, we don't expect that coming down materially. So can companies continue to pass those along to their consumers? And that's why we're so interested on the retail front around at the tip of the spear, the low-income consumers paying more because of rent, because of fuel, because of food. Can they really take on any more increases? And I think that's for the next second half of the year is going to tell us a lot.
One sector is lower on the month. I mean, it's turning out to be a great month for the market, but one sector is weaker, and that's energy, which is actually down. It looks interesting to you right now?
It is. Energy is intriguing to us because we do think that WTI will be higher for longer. We're not bringing on the type of production that you might want, and we know it's going to be a longer transition to the green energy forum, and that's a place to be. So we still think there's a little bit more challenge there just in terms of what we've already heard around some of the deals that have been done and whether or not they can execute on those, such as with Hess. But we are intrigued by energy, certainly with the valuations.
It's interesting because we got an OPEC meeting coming up this weekend. China demand remains an open question. American car engines just get nothing but more efficient year after year. And as a result, the oil intensity in our economy gets less and less. I mean, the 1970s were a far cry from that, right?
100%. And I think what we look at, though, is that the transition is going to take at least a decade over that time. And yes, we are seeing more efficient cars, but we're also bringing on more cars. And when you think about the amount of trucking that goes on, when you think about that on a global scale, even the emerging markets, they still require so much more from a fossil fuel perspective. So, again, as a percentage of our portfolios, energy is not large, but relative to the sector weight there, we're intrigued by it. And that's just a place that we're looking right now.